Good morning, everyone, and thank you for joining us today. My name is Richard Barnwell, and I'm a partner within BDO's FS advisory practice. My focus is on governance, risk and conduct across the FS sector. So as you can imagine, it's been a busy few weeks for myself and my team. The first thing I wanted to say is that from all at BDO, we hope you and your respective teams, families and loved ones are safe and well during this difficult time. I did also want to mention that we are live today. We had pre-recorded the session, but for a number of reasons we've decided to do it live. So I've tried to hold myself away at my home, but I do apologise if the doorbell goes or my young daughter somehow tries to break into the room. Over the past few weeks, as you'd imagine, we've been supporting our clients respond to the crisis. And through this, together with ongoing conversations with the FCA, PRA and trade bodies, we've gained insight that we're very keen to share. Obviously, every firm will have different priorities and challenges. Today, we're going to be covering some broad topics which we feel are relevant to all firms. The audience for this webinar consists of clients across the FS sector, and therefore we've made the content largely sector agnostic. That said, we will be touching on some sector-specific examples. To this end, we are planning on focusing on key three areas: governance and operational resilience, conduct, and prudential-related issues. We're also delighted to have Simon Hills from UK Finance joining us this morning. Simon leads the Prudential Capital and Risk team at UK Finance, which focuses on influencing the implementation of reforms to capital and liquidity requirements in the UK. He also leads UK Finance's work on the Senior Managers and Certification regime, which seeks to improve, as you all know, bank-wide governance and culture, and has extensive knowledge of prudential regulatory architecture. I know Simon has been working very closely with regulators and firms over the past few weeks, and he will be sharing his observations towards the end of the webinar. Before I start with the content, I did just want to touch on a few housekeeping points. So today's webinar is going to be recorded, and we will circulate the slides later, and also you will have access to the recorded webinar. Your lines are going to be automatically muted throughout the webinar. There is going to be time for questions at the end, so what we ask you to do is to please submit your questions as we go through the presentation today. There is a Q&A panel and box on the bottom right-hand side of your screen, and when you're typing in your questions, please just ensure that you're sending them to all the panellists. If you are having any problems with sound or anything else during the course of the presentation, just put a comment in the Q&A box and we'll try and address that as we go along. So hopefully that is all clear. So I'll start moving on with the content. So the first thing I did want to touch on was governance. The speed and breadth of the unfolding COVID-19 crisis is putting nearly every facet of businesses to the test. Responding to the humanitarian crisis is priority number one. However, there are also significant implications for board members who need to be decisive in protecting their people and organisations throughout this current phase of the crisis to the next one, and indeed the longer term. The buck stops with the board. We all know that an effective board defines the company's purpose and then sets a strategy to deliver it. This purpose is still relevant in the time of a crisis. While management teams run companies on a day-to-day basis, boards are ultimately responsible even in times of crisis. So, the starting point for boards in this crisis indeed, just like any other crisis, is to direct the company in a way that is effective for all key stakeholders. Transparency and effective communication become even more important during the time of crisis. Board members need to ensure that they have access to relevant information. Being clear on who is calling the shots is also important. Ultimate accountability is likely to sit with the CEO, but there will be other members of the management team who hold SMS who are also likely to have key accountabilities. The FCA has stated that they do not require firms to have a single senior manager responsible for the coronavirus response. Firms should allocate these responsibilities in the way which best enables them to manage the risks they face. There are, of course, existing responsibilities specified in the senior manager's regime, for example, SMF 24 for operational resilience and SMF 2 for financial resilience. Of course, there may be scenarios where firms need to make temporary arrangements to cover absences or change senior manager responsibilities in direct response to the pandemic. The FCA are keen to minimise the burden to firms at this time, so do not intend to enforce the requirements on firms to submit updated SOR, statements of responsibilities, for solo regulated firms if the change is made to cover multiple sicknesses or other temporary changes in responsibilities in direct response to the pandemic and is temporary and expected to revert to the firm's previous arrangements in the near future. They do expect allocations, however temporary, to be clearly documented internally so that everyone understands who is responsible for what. This should be available if they request it now or in the future. Firms' internal records should aim to keep a running commentary of their senior manager population and their responsibilities during this period. This includes keeping SORs, role profiles and responsibilities maps, if applicable, up to date. For dual regulated firms, the regulators expect firms to resubmit relevant SORs as soon as is reasonably practicable, taking into account the current circumstances, and they understand that firms may take longer than usual to submit revised SORs in the present environment. It's also worth noting that regulators are relaxing the 12-week rule for temporary arrangements for solo regulated firms, increasing it to 36 weeks. Firms do need to make notifications relating to this. There is an expectation that firms clearly document these responsibilities, however temporary, including SORs and responsibilities maps. Dual regulated firms still have access to the 12-week rule. Under the modification, firms will also be able to allocate the prescribed responsibilities of the absent senior manager to the individual who is standing in for the absent senior manager. Usually, PRs can only be allocated to another approved senior manager under this rule. Firms are expected to still do this if possible. Firms should still allocate to the most senior person responsible for that activity or area who has sufficient authority and appropriate level of knowledge and competence to carry out the responsibility properly. The covering manager will require access to the governance forums they need to exercise their responsibilities. I think in times of crisis, the quality of the relationship between the board and the executive management is critical. This is certainly no time for confusion as to who does what. I also wanted to cover what we are seeing and hearing in terms of the practicalities of operating effective corporate governance. In times like this, the need for clear and decisive leadership based on reliable information is more crucial than ever. Meanwhile, disruption to working practices makes this harder than ever. Change is inevitable in the face of disruption, so the key priority for boards must be to ensure plans are in place to maintain effective governance and, importantly, be able to demonstrate that it is working effectively. We're seeing management information flows disrupted, so firms need to be coming up with solutions to maintain and/or complement missing information. There are also scenarios where risk management and internal control systems may become unworkable. In such scenarios, boards and management need to be identifying these gaps and putting in place mitigating controls. If controls are to be relaxed, then any decisions around this need to be clearly evidenced, and it may be that additional monitoring needs to be put in place. Both the PRA and FCA have stressed the importance of continued strong governance through this crisis. It follows that firms are going to have to make a number of tough and key decisions in the coming months. Being able to evidence how and why these decisions have been made is more critical than ever. Now, I could spend longer on this talking about how individuals might go about demonstrating reasonable steps at this time. Alas, we do have other material to cover, so I'm going to move on. But what I will say is that we're going to be running a further webinar after the Easter break, which is very much going to focus on the topic of reasonable steps and how, in this current environment, SMFs can go about demonstrating reasonable steps. So now moving on to operational resilience more specifically. Clearly this topic interplays heavily with what I've already covered when talking about governance. In particular, the expectation that how a firm is managing operational resilience should very much be a focus of the board. So, what have the regulators said about operational resilience and what are their expectations? As you would expect, both the PRA and FCA have significant resources focused on their response to COVID-19, both for the firms they regulate and their own staff. Dedicated teams have been set up and the situation is being overseen by respective executive committees. They are in regular contact with firms to assess their current position and expect firms to be taking reasonable steps to ensure they're prepared to meet the challenges coronavirus could pose to customers and staff, particularly through their business continuity plans. There is a clear expectation for firms to provide strong support and service to customers during this period. They should be clear and transparent and provide support as consumers and small businesses face challenges at this time. Naturally, there is also a continued requirement for firms to manage their financial resilience and actively manage their liquidity. Firms should be escalating immediately to the regulators if they believe they will be in difficulty. All firms should have already in place contingency plans to deal with major events, and we expect these plans to have already been tested. Both the FCA and PRA are actively reviewing the contingency plans of a wide range of firms. This includes firms' assessments of operational risks, the ability of firms to continue to operate effectively, and the steps firms are taking to serve and support their customers. Firms should take all reasonable steps to meet the regulatory obligations which are in place to protect their consumers and maintain market integrity. For example, if a firm has to close a call centre, requiring staff to work from other locations, including their homes, the firm should establish appropriate systems and controls to ensure that it continues to maintain appropriate records, including call recordings if required. I'm sure you're all familiar with CP 1932. This is the recent consultation paper published jointly by the PRA and FCA, which sets out their proposals for operational resilience, and in my mind certainly gives us a very clear reference point for regulatory expectations in this area. Whilst these proposed rules are not yet in place, it's very reasonable, I think, to assume that the themes covered should all be front of mind as firms deal with this particular crisis. Just as a recap, the key proposals for firms within that CP include identifying their important business services that, if disrupted, could cause harm to their consumers, retail and wholesale, or market integrity, setting impact tolerances for each important business service, i.e. thresholds for maximum tolerable disruption to help achieve consumer protection and market integrity, identifying and documenting the people, processes, technology, facilities, and information that support their important business services, and also testing their ability to remain within their impact tolerances through a range of severe but plausible disruption scenarios, obviously one of which we're all living through right now. Conducting lessons learned exercises to identify, prioritise and invest in firms' ability to respond and recover from disruptions as effectively as possible is also a key feature within the consultation paper. And finally, it stresses the need to develop internal and external communication plans for when important business services are disrupted. Now, you may already have received contact from the FCA and or PRA. We know that firms are being asked for information on a range of topics which focus on how they are responding to the crisis. These have included, for example, describing how consumers have been impacted by the COVID-19 outbreak in the context of an individual business, requesting information on additional measures that the firm has put in place to support affected consumers, and asking for evidence of communications that a firm has in place around COVID-19 specifically. As I mentioned earlier on, it's been a busy few weeks for us. Through both our advisory work that we do, as well as our third line internal audit support that we provide to firms, we have been helping them very closely through this difficult time. This has included support to ensure that they are operationally resilient and, importantly, can clearly evidence to the regulator that they have taken appropriate steps and that where decisions are made, these are reasonable and based on the facts and information available. I thought it'd be useful in this slide just to set out some of the good practice that we are seeing. We've seen a number of organisations assemble cross-functional COVID-19 crisis response teams or working groups, which are typically led by a member of the executive management team. These response teams are typically defining key responsibilities, meeting frequencies, and management information requirements, and in turn provide regular updates to the executive committee and board. Further to BCP plans kicking in, time is also being taken to consider the current state. For example, undertaking detailed analyses of how consumers, clients, and more broadly, business services have been and will be impacted by COVID-19, identification of immediate current strains and pinch points with resources supporting the delivery of key business services, i.e. people, third parties, or key systems and infrastructure, and identification and communication with critical suppliers to understand their current status with respect to provision of outsourced activities and whether this is likely to impact those key business services that firms themselves have identified. Firms are also spending time to carry out additional scenario analysis and are identifying a range of severe but plausible scenarios that could occur in the short, medium and longer term in relation to COVID-19. The impact of these scenarios are being considered in the context of the resources which support the delivery of key business services, so including third parties, systems and staff, and the potential impact on clients, consumers, financial stability, and of course of the organisation. In turn, firms are developing very detailed response plans should any of these scenarios materialise in order to reduce the level of impact in the context of disruption to key business services that have been mapped out. Where firms already have in place established impact tolerances for operational resilience, we're seeing that these are revisited and revised. And for firms that don't already have them established, we're seeing a lot of work quickly undertaken to identify what these key indicators might be. The final area of firms' focus relates to communication. Most of the firms we're working with realise that ongoing and accurate communication is key given the ever-changing nature of the current situation. Firms are typically defining clear guidelines and frequency requirements for ongoing comms with staff and customers, clients. For firms that form part of a wider group, all plans need to be coordinated to ensure consistency across various entities. Time is also being taken to ensure that there is a plan of action for communication with the regulator, or indeed regulators, as this is likely to be requested. The communication should consider what the organisation is doing to minimise the disruption to its operations, details of the crisis response plan, overview of testing performed, including proposed responses, and planned communication arrangements with staff, customers and clients. Now, before I talk about conduct, I wanted to wrap up the operational resilience topic by stressing how important it is that not only you're taking appropriate measures to ensure you remain operationally resilient, which to be honest I think that goes without saying, but that you're also in a position to clearly evidence this to regulators and other third parties. It is our validation work on the decisions already taken and how this is evidence that our clients are finding most helpful. So now just moving on to conduct risk. It's clear that over the coming months, firms are going to have to balance their need to limit their exposure to COVID-19, both operationally and financially, with the demands of treating their customers fairly and ensuring the best possible outcomes in what are very challenging circumstances. I've already touched on the fact that the PRA and FCA's response to the crisis has been highly visible. The FCA in particular, as you would expect, has issued a number of statements and Dear CEO letters in recent weeks which clearly set out their expectations on how firms should carry out their business in the short term. It is a certainty that firms who do not have conduct risk and customer outcomes as a high priority will face significant scrutiny later in the year. It follows that firms should be investing time now to ensure that potential conduct risks directly related to COVID-19 are quickly identified and mitigated to minimise failures and avoid costly remediation exercises later down the line. One way we're seeing firms do this is by bringing their first and second line teams closer together so that they are fleet of foot in identifying potential issues in this rapidly changing environment. Establishing exception channels to cater for atypical sales, servicing or operational cases is also effective for dealing with instances of potential conduct risk. We've also seen temporary design authority groups established whose purpose is to review potential customer harms resulting from changes to existing processes and operations which have been brought about by COVID-19. We're also seeing boards and SMS considering a number of conduct-related questions. So how have consumers and or the product set been impacted in the context of the business for which they're responsible? Have consumers become vulnerable in new ways? And are you confident that you've identified all the ways your customers will be impacted? And another question that we're seeing boards ask themselves is, what additional measures has the firm put in place to support effective consumers, specifically vulnerable customers, and are these sufficient relative to the risks and challenges being created by the crisis? Rather than going into lots of specific detail on potential conduct risks across the entire FS sector, which time I'm afraid does not permit today, I've pulled together a couple of key themes to discuss. The first is complaints. Most firms that we're speaking to are expecting or already experiencing an increased number in the number of complaints that they're receiving. As time goes on, it's likely that this will increase further as a firm's operations and ability to meet service standards are increasingly tested. The FCA's expectation is that complaints continue to be resolved within the current 8-week time frame, 15 days for payment firms. However, where the pandemic prevents this, firms should contact the FCA promptly and write to the customer explaining why they have not met the deadline. Ensuring you have staff available to deal with complaints and have an effective root cause analysis process for identifying and responding to new trends is likely to be essential in the coming months. The other area that I wanted to briefly touch on was what I've called temporary financial relief. On the 2nd of April, the FCA proposed a range of targeted temporary measures designed as a stopgap to quickly support users of certain consumer credit products who are facing a financial impact because of the exceptional circumstances arising from coronavirus. These measures relate to credit cards, overdrafts, and personal loans, and include, similar to mortgages, the ability to defer payments for 3 months without impacting a customer's credit score, as well as interest-free overdrafts for customers in financial difficulties. I suspect you're already aware of the guidance that has been provided by the FCA and indeed the government in relation to mortgage payment holidays, and as I say, these have been very well publicised. In a nutshell, they include payment holidays for up to 3 months and a freeze on repossessions. I think we will all agree that these are sensible measures given the impact that coronavirus is having on the wider economy. These measures, though, do present significant conduct risk for firms as the potential for processes to fail and for customers to receive poor outcomes are greatly increased. On the topic of arrears and repossessions, we're working closely with a number of firms and the volume of requests for payment holidays is high. These firms have quickly had to revisit existing procedures and controls, provide training, and increase the level of compliance monitoring and testing to ensure the requirements set by the FCA are being met. This is all having to be done with large parts of the workforce working from home remotely. Quite a challenge. Obviously, the conduct risks that firms face will vary from sector to sector. Complaints is a sector agnostic, and temporary financial relief is only likely to apply to credit institutions. Insurers, for example, are likely to see a spike in claims, and as with arrears handling, they need to ensure that they are able to cope with this increased volume in a way that does not lead to poor customer outcomes. And of course, other sectors will have different specific issues. We're actually in the process of scheduling a number of additional webinars to focus on conduct matters. These will be happening after Easter, and one is going to focus certainly on arrears and forbearance for lenders, and we're also going to be holding another one on claims handling for our insurance clients. My final word on this is to ensure, please, that you're all carefully considering what impact COVID-19 has on your conduct risk environment, as any mistakes you make now which lead to poor customer outcomes are likely to prove very costly at a later date. With that, I'm going to hand over to Oyvind, who's going to talk about some prudential related matters.
Well, thank you very much, Richard. Morning, everyone. My name is Oyvind Andersen. I'm Director in the FS Advisory Team, and I'm going to talk you through some of the challenges we've seen in the capital and liquidity space, and also explain how regulators and financial institutions have been dealing with these. I think one important thing to note is that banks and regulators are in a much better shape now, both from a capital and a liquidity perspective than the 2008 crisis. So consequently, they are therefore much better prepared for short and long-term challenges. And to that note, we have seen several critical steps being taken by regulators to ensure financial stability. And I've listed some of these on the slides that you have in front of you. I think the first thing to note is on the capital supply side, banks have committed to stop dividend payments for the next year and also halted cash bonuses for senior management for larger firms. And this will no doubt preserve capital for banks and for other institutions, but it's also reflecting the expectation from the wider society and regulators that banks should do their part in ensuring solvency and stability. We've also seen on the capital demand side that one of the main regulatory interventions has been the removal of the 1% counter-cyclical buffer. This is significant because it reduces the capital requirements for firms subject to CRD4 by 1% of risk-weighted assets for the UK exposures. And this frees up a significant amount of capital. It is expected that this will support up to £190 billion of bank lending to businesses. We have also seen other jurisdictions, including the EU and the US, taking similar steps to make more capital available. We also see that from a funding perspective, the regulators have introduced the term funding scheme, which is an additional tool that's been enabled to supply credit to the UK economy. This scheme will offer 4-year funding of at least 5% of participants' stock of real economy lending at interest rates very close to the bank rate, which we all know is currently historically low at 0.1%. And this is a very important initiative as it mitigates the effects of banks' inability to cut interest rates in the current low-rate environment. And additionally, there'll be more funding available for small and medium-sized businesses. And previous experience and modelling suggests that this new scheme could provide funding in excess of £100 billion to businesses. And we've also seen that to further shore up liquidity, the Bank of England has confirmed that it will continue to maintain its stock of UK government bond purchases. This is important because it will send signals to the retail market that it is very much open for business and therefore will enable firms to access liquidity. We've also seen from a supervisory perspective that, as Richard mentioned earlier, the regulators have been very active, and we have seen the PRA taking active steps to communicate with firms to requesting updated forecasts, capital plans, and for some firms, daily capital calculations. We very much expect this hands-on supervision to continue during the COVID-19 crisis, given all the uncertainties that are around. We've also seen the PRA given additional guidance to firms, both on IFRS 9, so impairment treatment, and on market and counterparty credit risk models. For IFRS 9, the consensus largely remains that COVID-19 will, for most firms, be a non-adjusting event for 31st of December 2019 year end. But firms do need to start to assess the potential impact, including areas in stress in their portfolio in terms of expected credit risk, credit losses. And the PRA has given specific guidance on this in a letter from Sam Woods to CEOs. And to help you with this, we are planning a separate IFRS 9 webinar on the 16th of April, hosted by my colleague Mark Spencer. And finally, on market and credit risk models, we've seen increased volatility in the market that spiked capital requirements. The PRA has permitted firms to offset some of these increases seen in the models due to the use of higher multipliers. So that's just some of the things that we've seen the regulators have done. And on the next slide, I'm going to talk about some of the challenges that we have seen, both from a capital and liquidity perspective, and how firms can mitigate and consider these where possible. And starting with capital, you'll see to your left here that I've listed several challenges. Firstly, and particularly institutions with trading books and assets that are marked to market may see increased risk-weighted assets due to volatility in market and credit risk models. Additionally, we also see that some rated counterparties will suffer downgrades, which in turn will result in higher risk-weighted assets. This is something that we saw very much happening during the 2008 financial crisis. So again, a large increase in risk-weighted assets may be a challenge for some firms with, that have smaller capital buffers. Secondly, we also expect in the medium to longer term an increase in impairments that will in turn affect IFRS 9 and firms' expected credit risk model. This is largely driven by higher default rate in certain sectors, particularly in retail, leisure and travel. It is expected that firms need to revisit their ECL models and start to assess the impact of this. Thirdly, given the expected contraction in the global economy, it is expected that this will fuel lower demand for financing, particularly in certain sectors, as I mentioned earlier, travel, leisure and retail being key areas. This is likely to affect the income levels for banks and investment firms. And finally, the COVID-19 events may result in unexpected changes to firms' funding costs and therefore the availability of capital. And this may result in higher funding costs and capital requirements. And this is particularly relevant for firms that rely on short-term funding in the money markets. And critically, as you'll see to the right side of the slide you have in front of you, it is paramount that firms demonstrate to stakeholders that they are considering these challenges and identify the appropriate actions and mitigants. And one of the key things that we have seen and identified is for firms to revisit their capital plan and forecast based on updated assumptions for both capital requirements and capital resources. These are the two key drivers of firms' capital ratios. And by revisiting these with the correct assumptions, firms should quickly be able to assess if they have sufficient internal capital, and they can therefore decide what action to take. Really, really important that firms, revisit these at least for the next 12 months forecast. And linked to the above, firms should also revisit their stress testing scenarios to see if they are still valid and appropriate. And things to consider are the longer-term impacts of COVID-19. I mentioned some of those challenges earlier, like lower demand, for example. But also firms should consider if new scenarios should be added. So, for example, do you actually have a scenario with COVID-19 impacts in it? Really, really important to consider that. And thirdly, firms need to be really, really clear how they communicate with both internal and external stakeholders. And whilst the regulators are keen on getting information quickly, firms should still allow for sufficient time to present credible rather than rush solutions rush solutions to regulators and stakeholders. This is really, really important because mistakes that are made at this stage can be costly at a later stage. And fourthly, firms should carefully look at their recovery plan to ensure that this is relevant and up to date. In particular, revisiting your recovery options may be useful as it enables you to validate that these options are still relevant and applicable in the current stress environment. For example, will you still able to access funding from external counterparties or internal group entities in the current environment? And so firms really need to go and test and check that these options are credible. And finally, I just also want to touch on risk appetites and how important it is to revisit this and make sure that this is up to that this is relevant and you have calibrated your risk appetite with the associated limits and triggers, and this will enable you to have the correct monitoring requirements in a very uncertain time. And this exercise also applies to liquidity and, in fact, all risks, not just capital. Moving on to my, to my final slides on liquidity. This comes up here. This sets out some of the challenges that firms may experience in the liquidity environment. And you'll note that some of these challenges are very similar to capital, although we normally expect liquidity events to be much more acute than the challenges we've seen in the capital space. And evidence from the 2008 financial crisis highlighted that firms went bust or went into trouble because of liquidity and not necessarily because of capital. And as you see to the left, I've listed some of the key challenges that firms are exposed to. So some smaller firms may see higher outflows. So basically clients taking deposits out, as there is a flight to quality resulting in concentration with certain counterparties. Again, this is something that we saw in the 2008 and other smaller liquidity crises. And outflows may accelerate for firms with exposure to certain counterparties, in particular sectors such as retail, leisure and travel, as some of these customers need the liquidity to maintain their business operations. And secondly, some firms may struggle to get access to liquidity, or if they do, it comes at a much higher cost. Particularly, this is relevant for firms that rely on short-term funding. And this has to some extent been mitigated by regulatory and central bank intervention, where the additional funding has been available, as I mentioned earlier. And we have also seen increased volatility in asset prices. And this, again, translates into higher margin requirements for firms that have a trading book. And this, again, drives higher liquidity and capital and collateral requirements. And as a result, firms need to set aside a higher liquidity buffer. And we also see, from a liquidity perspective, that the funding costs are higher, as many firms are looking to change their funding strategy, either because the counterparty that they get funding from has changed their risk appetite, or because the firm itself needs to change its hedging strategy. So these are some of the challenges that we have seen or expect to see. And to the right here on the slide, you'll see that I've set out some of the considerations and mitigations that firms should think about to mitigate these. And really the first step is, as we've seen with the capital plan, is to revisit your funding plans and your forecasts using the up-to-date assumptions for both your liquidity buffers, so the liquidity you've set aside, and also what kind of outflows and inflows you will see. And this should quickly enable firms to assess if they have sufficient liquidity to meet their liquidity requirement, both internal buffers but also external requirements such as LCR ratios for banks. And linked to the above, firms should revisit their stress testing scenarios to see if they are valid and appropriate. For example, has there been any changes to your stress testing risk drivers? firms really need to consider if there are any longer-term impacts of COVID-19 and whether some additional scenarios should be added. And then thirdly, as I mentioned earlier, firms need to be very clear on how they communicate with both internal and external stakeholders. And this includes allowing for sufficient time to present to regulators and stakeholders with appropriate and relevant communication. And firms should consider carefully what information is relevant to the regulators and what they commit to. They need to ensure that this can be executed within the right timeline. And then finally, and this is a very important point, firms need to revisit their contingency funding plan to ensure that this is fit for purpose and that the actions can be executed within the first timeline. The contingency funding plan is, from a liquidity perspective, some of the first things the regulators will ask for. So again, if some of the options in your contingency funding plan are not credible, you really need to update those and reconsider them. And we also seen that the PRA has already asked some firms to confirm this and to validate their contingency funding plan. So that's all I wanted to cover this morning from the prudential perspective. I'll now hand over to Simon Hills from UK Finance for a summary and a further Q&A session.
Thanks very much, Oyvind. And I just wanted to sort of re-emphasize those points that you made. You know, all the authorities, the PRA, where my interest lies mainly, as well as the FCA and government, have been immensely helpful as we plan for the economic impacts of COVID-19, so we can help our business and personal customers, because that's what we must do now. And I'm quite sure everybody on this call is fully brought into that. So, Oyvind, as you said, the release of the counter-cyclical buffer at the beginning of March, resetting it to zero, supports 190 billion of new lending, 13 times net lending last year. So there's plenty of fuel in the tank to support our customers. And of course, individuals and businesses will benefit too from the unprecedented levels of government support. But of course, we don't know yet what the impacts of this are going to be on our customers and in due course on us as banks and our capital positions. But the PRA continues to emphasize that capital buffers and liquidity buffers are there to be used. So do use them if you need to. There's no shame in doing that to support your customers. The Dear CEO letter on the 26th of March provides some helpful guidance in this regard by saying that temporary relief measures shouldn't in the short term result in migration of exposures from stage 1 to stage 2 for IFRS 9 purposes or trigger an event of default. The EBA guidelines on definition default, in fact, have a provision in them that was fleshed out by the EBA just last Friday, that public or private moratoria introduced in just these circumstances shouldn't trigger events of default or forbearance assistance. And the Basel Committee echoed that over the weekend. I think that the same view is implicit in that Dear CEO letter, but we've asked the PRA for explicit confirmation. This is their view too. And I'm sure by the time of the next BDO seminar on the 16th, when we're going to think about IFRS 9, we may well have a response to that. Looking forward, however, from an IFRS 9 perspective, we, as I think Oyvind mentioned, there will be a question about what a downside scenario looks like for stress testing purposes, given the extensive government relief that will be so beneficial to our customers. Perhaps we should jointly develop an official, if you like, downside scenario with the authorities, given that this year's stress test has been cancelled. And I know that many of you use those scenarios in the ACS to inform you about your own ICAP stress testing. As Richard mentioned, we'd approached the FCA and the PRA with questions around the application of the 12-week rule and had some helpful and pragmatic discussions and feedback with them about how we might think about updating statements of responsibility and management responsibility maps. But I think there's another business as usual task that some of your HR colleagues and others are doing at the moment, which is uploading information to the enhanced FCA register. And it looks like that is becoming a bit of a dog's dinner. So we're engaging with the FCA on that at the moment. We just don't think us sorting out these teething problems is a good use of our time. As I said, the PRA and FCA have been immensely helpful and want to continue to be so. We wrote a letter at UK Finance on your behalf to the authorities in the middle of March about a range of issues, which included the issues around the IFRS 9 definition default, which elicited some really helpful temporary policy changes. And we're in the process now of thinking about what are other asks we might need to put forward. On my list so far is delaying the non-mortgage elements of the IRB repair program. The mortgage definition default work has been already delayed to the beginning of 2022, but we think that given that modelers are helping frontline lenders help their customers, they're not really able to work on non-mortgage modelling changes. So we're suggesting that element of the IRB work should be delayed until the 1st of January 2023, which would hopefully align with the revised Basel 3.1 implementation date and avoid us perhaps going back for multiple model waiver applications between now and then. Also on that list is an issue around significant risk transfer and securitization, the definition of default point I mentioned earlier, IFRS 9 issues, of course, and then also a suggestion that the resolution assessment framework requirement should be delayed along with recovery and resolution activities, given we're effectively in an early recovery situation now, as Richard mentioned, so we're actually living it in real life. Let's not spend time theorizing about it at the moment. So as I said, plenty of appetite from the PRA to consider additional COVID-19 related issues. Get in touch with me if you've got any bright ideas or like us to ask about particular issues on your behalf over the next few days. So with that, shall I hand back now to colleagues at BDO to think about some of the questions that I can see some of you have already asked. Richard, over to you.
Thank you, Simon. Yes, it's Richard here. So yeah, we've had a lot of questions coming in. We've only got 10 minutes, so we're probably not going to be able to go through all of them. But if you haven't asked a question and do want to, please still type it into the panel, because we can obviously circulate a list of them all after the event together with sort of answers. So one of them that I've seen is around the communications from the regulator that I mentioned. So a question around what have we seen going to firms by way of requests or ongoing comms. So certainly from an FCA perspective, a number of our clients have received sort of information requests, is perhaps pushing it a little bit, but have certainly been asked a series of questions which specifically relate to COVID-19 and the firm's response. I mean, and that's ranged really from being quite detailed, specific questions around what are you seeing in terms of levels of staff sickness and absence, and how is this impacting your services, to sort of broader questions, which I think I touched on earlier in my presentation around, well, what have you done to start thinking about what impact this is having on your products and services, and ultimately then consumer outcomes. So, you know, I wasn't sort of making up what I said. I think, you know, there is a need for all firms to be in a position to answer what I think are quite reasonable questions. The other thing that they've perhaps probed on a bit is what firms' communication plans are, both internally and externally, around this. I think I don't need to go into lots of detail, but I think even prior to COVID-19, we've seen a number of kind of operational events that have happened in the financial services community over the last 12 months. And I don't think any of the regulators have been particularly enamoured necessarily with firms' responses to them. So communications absolutely is featuring heavily. And then finally, just a word on the PRA. I'm sure that the larger firms and indeed some of you on the call as well today may have and I hope have had contact with the PRA. Our understanding is that they are going to be sharing a sort of a more formal data request, certainly amongst the banking community, at some point in the near future, if indeed they haven't done so already. I mean, my expectation, given how the regulator often works, is that may well hit people's inboxes just ahead of the Easter weekend, probably with a relatively short and sharp turnaround. Just in terms of other questions, I saw one from Chris Lewis, actually, just around access to the loans for SMEs. So whilst specifically within sort of our world, the clients that we're dealing with, it's more on the other side of it, i.e. preparing and providing the loans. I mean, as you'll be aware, BDO has a really big footprint in the SME space, and I certainly know from colleagues, a bit like the question was alluding to, that small businesses are finding it really difficult to access these loans. So very happy, perhaps after the call, to put you in touch, Chris, with the right people at our end who can give you a bit more detail on that. And yeah, we've got loads of quite informative information for businesses around what's available and how they go about actually accessing them. Another question that I saw was around quite a detailed question, but a good one nonetheless, around the prescribed responsibilities. So I mentioned, that's from Adam actually. Good to hear from you, Adam. So the question was, where you've got non-SMFs who have prescribed responsibilities allocated to them in the absence of the SMF, will they have the same statutory personal accountability? Good question. So I think what I would say there is, certainly the guidance makes provision for this scenario, i.e., it's clear within what's come out from the regulator that they're happy for non-SMFs to pick up PRs in this specific set of circumstances. What isn't clear is what the level of statutory personal accountability will be for that individual. I mean, I don't like answering things off the cuff, but I think the fact that they aren't SMFs is likely, strictly speaking, probably to limit the PRA and FCA's reach on that individual, a point later down the line. However, it goes without saying that such individuals should clearly be taking these responsibilities seriously. And I suspect the regulatory expectation will be that they, just like an SMF, should be in a position, if ever challenged, to demonstrate what reasonable steps they've taken to actually fulfil that role. So maybe it doesn't answer the question, but we haven't seen anything specifically that addresses that, and all I can really give you is my sort of view. The other one that I've seen there's been a couple of questions on is around the sort of the evidencing and reasonable steps point. I mean, as I said, I think that's quite a detailed topic. I'm probably not going to be able to do it justice in answering here and now. And we are going to have another webinar after Easter to sort of focus on that in a bit more detail. I think what we are seeing, though, and some of the questions that we're seeing from the regulators around this in terms of, talk us through what you've done as a firm in response. It goes back to all of the things that I mentioned in terms of what good looks like. So I think as a board and as a management team, you need to be able to clearly evidence and demonstrate that you've mobilised, a number of key senior individuals to look at this, and indeed this should follow whatever BCP plan that you've got in place. And indeed, if you'd already started doing work on operational resilience specifically, you should be leveraging that. They're going to want to understand what's been done to identify key businesses and services. and what the rationale is that sits behind that. They're going to be expecting for those key business services that you've identified kind of thresholds and KPIs that ultimately can then flow up through the right governance framework to the board, so that you know whether or not for those key business services you are fulfilling them to a standard that everyone's comfortable with. I mean, and I think, you know, this is where then the judgment comes in and where the evidencing becomes even more important, because you are going to have to make calls, around, you know, something not necessarily being specifically critical, you know, and that may well be a judgment call, and in doing so you're going to be able to need to demonstrate the conversation that went around that and why that decision was reached, you know, and likewise in terms of the tolerances that you're setting yourselves for the specific services that are identified as key and critical, you know, why you're setting it at that particular threshold, what you're doing to monitoring it, and then also what you're doing on an ongoing basis, maybe to tweak that threshold depending on what you're seeing. But as I say, that you know, I think as this moves on, and hopefully sooner rather than later the dust settles, so to speak, and we approach some level of normality, I think this is going to be a key focus area for the regulators after the event. You know, will be certainly where and if things have gone wrong, what a board and management able to evidence in terms of how they reacted to this crisis. So, you know, it's difficult at the moment because obviously you can't meet with individuals, but trying to put in place appropriate workarounds so that you can evidence that there is conversation and discussion going on is going to be very, very important.
It's Simon here, Richard. Tangentially on that, you know, I think we all recognise, don't we, that if our customers do take account of temporary relief measures, the chances are the cost to them, although we'll spread it over a maybe increased period, will be higher. And I think we have to be absolutely clear with our customers to the fullest extent possible that, yes, we're really happy to be granting you this relief, but it doesn't come at no cost to you, and you as our client need to understand that. And I think that protects us from, you know, potential claims management companies in 2 years' time. Yeah, and I mean, you know, going back to my conduct point, I think that's very much going to be a big risk going forward. Is that, you know, we see customer harm, and, you know, lots of remediation exercises, so you need to be anticipating that in advance. I think was there a sort of a buffer question, Oyvind? I don't know if you picked that one up.
Yes, Oyvind. Yeah, there was a question about how we see other banks and firms are thinking about releasing buffers, which, you know, there's something that the regulators have said are available, and, you know, the follow up to that is, are there any are firms nervous about that? And I think my sort of initial answer on that is, yeah, in my experience, firms are very nervous about dipping into capital buffers. And the reason for that is that you effectively sort of dip below your set risk appetite and your risk indicators. And I think as a result, there is an expectation that you will need to have some options available that are credible, where you can sort of get you back on an even keel. So whilst I think it's great that the regulators have said that, I think it's very much, you know, firms are nervous about going into using the buffers. I think that will not send a signal of strength to both internal and external stakeholders. I'm not sure if you have anything to add on that, Simon.
Yeah, I think that's one of the points we continue to make in our engagement with the PRA, and I'll make it in the point, and make this point in the letter we're in the process of finalising now, the follow-up asks letter. I think that I can understand that boards would be nervous, as you say, Oyvind, about digging into those capital buffers. But again, the PRA has emphasised, you know, more than once, those capital and liquidity buffers are there to be used, and I said no shame in doing so. So I think those of you who are on the call and can influence your boards should be making that point to them.
Okay, well, I'm going to wrap up now. I mean, I'm sorry if we've not been able to answer your question because we did have quite a few, but we will answer them, if you like, sort of after the event. So we will come back to you on those things. You'll get an email which will provide you with the slides. As I say, there will also be access to the recording of the webinar, so we'll send that through, and obviously then feel free to share it. And also, I think there's going to be a sort of a short questionnaire for you to answer in terms of feedback. So we'd be really appreciative if you could do that, because I think going forward, we're going to be looking to ramp up our number of webinars, and whilst we have lots of experience of doing these, we're always quite keen to fine-tune. And I think the other thing that we're also very keen to hear from you on is if there are specific topics that you do want us to cover, because I appreciate this one's been quite broad, but we're certainly planning on doing sector-specific webinars. And as I said, I think certainly in the conduct area, it lends itself to that. So if you have specific ideas or things around what you want to hear, then do let us know. And I think over the course of the next few weeks, we'll look to set up those sessions and create a forum for everyone to have a discussion and hopefully for us to get through this. So I will say goodbye now. Thanks for attending. We hope to see you again at similar events, and please keep well and safe. Thanks very much.